Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from RNZ on the 7th of November, current first home buyers paying less but getting more. Topic number two, the Mortgage Mag on the 5th of November, banks assess what stresses could destroy capital buffers. Topic number three from interest.co.nz on the 7th of November, newly released 2023 census data shows that around 1 in 16 houses in New Zealand are too small for the number of people living in them. Topic number four from NZ Advisor on the 6th of November, NZ property market shows sign of revival. Topic number five from RNZ on the 6th of November, building consents are up, but time needed for new builds to return, economist says. And topic number six, we've got a bonus topic this week from the Business Desk New Zealand. On the 6th of November, advisor liability gap leaves couple with no easy options. So first up this week from RNZ on the 7th of November, current first home buyers paying less but getting more. First home buyers are finding better opportunities in 2024 with lower prices and larger properties available compared to recent years. CoreLogic data shows a drop in the median price paid by first home buyers, down from $715,000 in 2022 to $685,000 in 2024, alongside a higher proportion of standalone house purchases, which now account for 73% of first home buyer acquisitions. CoreLogic's chief property economist Calvin Davidson observed that the current market allows buyers to get good deals as prices remain up to 20% below their peaks in some regions. This has led to some buyers to opt for standalone houses, which now offer greater affordability than smaller property types in past years. However, Davidson noted standalone purchases are still less common than in 2019 and 2020, when they made up over 75% of first home buyer transactions. First home buyers represented 27% of all property purchases in the first 9 months of this year, notably above the long-term average of 21%. So it's great to see first home buyers taking advantage of current market conditions. Davidson highlighted that despite subdued market activity, this year is a record high, driven by factors like KiwiSaver withdrawals, low deposit loans, and flexibility on property types or locations. Conditions are particularly favourable for first home buyers due to reduced competition from other buyer groups and lower prices. Wellington leads the main centres, with first home buyers making up nearly 35% of purchases, while Tauranga is at the lower end at 23%, but still above its typical level. Auckland, Christchurch, Dunedin and other smaller cities also show above average first home buyer activity. Looking ahead, Davidson expects first home buyers to maintain their market share, despite potential competition from some investors re-entering as interest rates decrease. New debt-to-income ratio rules might impact some buyers, but banks' allowance to lend to those exceeding limits could benefit first home buyers in pricier areas. Davidson sees first home buyers holding a strong share of the market in the coming months as other groups continue to face challenges. And at this time, we're not seeing debt to incomes affecting too many people. It's still the loan servicing that seems to be the sticking factor rather than debt to income ratios. Topic number two from the Mortgage Mag on the 5th of November, banks assess what stresses could destroy capital buffers. The Reserve Bank of New Zealand, RBNZ, recently had 13 banks conduct reverse stress tests to explore scenarios severe enough to push their capital below regulatory minimums. The banks created their own severe but plausible scenarios, with geopolitical risks emerging as the primary cause of potential recessions in New Zealand. This focus is in line with recent events, as previous recessions were triggered by the COVID-19 response and the global financial crisis. RBNZ noted that these stress tests generally produced more severe capital impacts than its standard tests, aside from the extremely severe 2020 COVID-19 scenario. Kerry Watt, RBNZ's Financial Stability Director, emphasised that geopolitical tensions pose significant risks for New Zealand's open, trade-dependent economy and underscored the importance of managing these risks to maintain financial stability. Beyond geopolitical factors, banks included scenarios such as natural disasters, like earthquakes and volcanic eruptions in Auckland, disease outbreaks, and a possible future pandemic. Some banks also considered the impact of declining insurance availability, factoring it into their credit risk models. Cybersecurity incidents and climate-related events like floods and droughts were also part of the analysis. The exact impacts of these scenarios are unclear, as neither the banks nor the specific scenarios for each institution were identified. Notably, assumptions about unemployment ranged from 8% to 18%, with past rates reaching 11.2% in 1991. The economic contraction forecasts varied widely as well, from a 3% decline to 24% decline, with recent data already reflecting significant GDP drops since late 2022. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced property investor and a financial advisor, and these events are available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 3 from interest.co.nz. On the 7th of November, newly released 2023 census data shows that around 1 in 16 houses in New Zealand are too small for the number of people living in them. The 2023 census data revealed a continued rise in household overcrowding in New Zealand, with more than 100,000 households now classified as overcrowded, according to Statistics New Zealand. Approximately 1 in 16 households faced crowded conditions in 2023, up from 1 in 17 in 2018 and 1 in 20 in 2013. Overcrowding is assessed by the Canadian National Occupancy Standard, CNOS, which measures whether a dwelling has enough bedrooms based on household composition. Statistics New Zealand noted that while overcrowding was worse in the 80s, it improved in the 90s but has worsened again in recent years, despite significant new housing construction. This trend is troubling, according to Goodyear from Statistics New Zealand, as crowding can impact physical health and increase the risk of infectious diseases. The only region that didn't experience a rise in crowding between the 2018 and 2023 census was Auckland, though it already had high overcrowding rates. In 2023, Gisborne had the highest regional crowding rate at 10.7%, followed by Auckland at 8.8%. I think it's worth noting that a lot of properties in both of those areas were significantly affected by the flooding. Within Auckland, South Auckland areas such as Mangere, Otahuhu and Otara Papatoetoe showed particularly high rates, with roughly a quarter of households affected by crowding. So interesting to note that the recent stats also showed that there's more people that are living in smaller households now as well. So, potentially with a number of the new builds that have been released that are 1 or 2 bedroom properties, that could help with this overcrowding, although it is pretty common in current economic conditions for family members to move back in with other family members, which could be part of the reason for this increased crowding since 2023. Topic number 4 from the New Zealand Advisor on the 6th of November, New Zealand property market shows signs of revival. A recent New Zealand Home Loans Property Report by Tony Alexander highlights a steady rise in buyer activity, with a rebound in investor interest and sustained demand from first-time buyers. The report, based on insights from 283 real estate agents across New Zealand, reveals a stabilising property market with increasing buyer confidence and greater auction attendance. Investor interest has surged, with 43% of agents noting a rise in buyers seeking properties. Falling interest rates and expectations of price increases are driving this trend. This marks the highest investor interest since November 2020, reversing the decline seen in mid-2023. Many investors are hoping to find bargains and capitalise on future market growth. First-time buyers remain a significant force, with 56% of agents reporting higher activity from this group. Despite a growing number of properties for sale, price pressure is pretty balanced. Rising property appraisals, with 58% of agents noting increased valuation requests, suggest growing buying and selling activity. The market shows steady growth, with a 30% increase in auction attendance and a 52% rise in open home attendance. Auction participation has now increased for 5 consecutive months. While prices are rising slightly, with 8% of agents reporting increases, they are still well below the highs of early 2023. Buyer sentiment remains cautious yet optimistic. While 19% of agents report signs of FOMO, fear of missing out, the same percentage observe FOOP, fear of overpaying. Buyers are taking a balanced approach, recognising market improvements but avoiding hasty decisions. Offshore interest in New Zealand property remains low, with 15% of agents noting fewer inquiries from abroad. Instead, local demand, driven by favourable borrowing conditions and attractive property prices, is the primary force behind the market's recovery. Access to financing remains a key concern for buyers, with job stability also affecting confidence. While fears over rising interest rates have certainly diminished, income stability is now the primary worry due to rising unemployment. The number of properties sold by investors remains stable, likely due to rising costs such as insurance and council rates. Many investors are selling to capitalise on their assets for retirement. The report suggests that the New Zealand property market is poised for a gradual, sustainable growth, driven by local demand and stabilising prices. With strong interest from both first-home buyers and investors, the market is positioning itself for a healthy recovery. And that reflects exactly what we're seeing in the property market as well. Increased interest from first-home buyers as well as investors, new investors as well as experienced investors coming back into the market. Something of interest to note, though, is that that the people that are entering the market are certainly looking at getting good deals, and the investors in the market are certainly less interested in purchasing new builds because they've seen some of the scary headlines that we've seen recently about people in some severe financial difficulty from buying new builds towards the peak of the boom and then having to settle after the market entered the downturn. So unfortunately, there were quite a few people that were caught unawares by that, potentially by companies that sold new builds. Just saying. Topic number 5 from RNZ on the 6th of November, building consents up, but time needed for new builds to return, economist said. An economist has noted that while building consents are increasing as interest rates fall and the housing market stabilises, it will take time for demand for new builds to fully recover. Westpac data shows a 2.6% rise in residential consents in September, with levels stabilising this year after significant declines in previous years. Senior economist Satish Ranchod believes this indicates the construction sector's downturn is nearing its end. Ranchod predicts a true recovery will begin in 2025. He acknowledged that while the outlook for new construction remains soft due to still high interest rates and cautious buyers, falling interest rates in a recovering housing market will eventually encourage more buyer and developer interest. However, he cautioned that this shift will take time, with significant improvements expected to start in 2025. He also noted that if house prices and construction costs decrease next year thanks to lower interest rates and inflation, that would benefit new builds. On the other hand, non-residential construction continues to face challenges, with soft business activity limiting new work, although some areas like office redevelopment are showing signs of strength. And the bonus topic for this week in review from Business Desk, New Zealand on the 6th of November, advisor liability gap leaves couple with no easy options. Financial advisor Hannah McQueen's sale of her Enable Me brand to AMP's Advice First has left one retail client unable to file a complaint regarding previous advice, sparking concerns over a regulatory liability gap. The client, who wished to remain anonymous, expressed frustration, saying that the sale left them hung and dry. The client's issues arose after McQueen advised them to buy a $956,000 new-built townhouse from Wolfbrook Residential in Henderson, Auckland. This investment required more financing than initially projected, which became costlier with rising interest rates and falling property values. Advice First Managing Director Mark Ennis explained that the client's losses were related to both general market risks, noting that higher interest rates and lower property values are common and outside of an advisor's control. Both Advice First and an Enable Me senior advisor reviewed the complaint and found no fault in the advice, Ennis stated. He emphasised that Enable Me had advised clients on potential market risks, and Advice First's internal investigation had confirmed that the losses couldn't be attributed to McQueen's actions. Despite this, the client remained concerned about several factors. McQueen had initially based her recommendations on a 4.5% interest rate, while the client suggested using an 8% projection. McQueen, however, reassured them that they could manage potential shortfalls with their cash flow. The couple settled on the property in November 2023, but had to put down a larger deposit from their home equity due to a property valuation drop and increased financing costs, reaching 7% interest rates instead of the 4.5% that they had their analysis based on. They now believe that if they'd been fully informed about alternative, nearly new housing investment rules and loan-to-value ratio, LVR lending options, they might have opted for a less costly property. The sale of Enable Me led to changes affecting the client's ability to escalate the complaint. With McQueen's transition from FSCL to the Insurance and Financial Services Ombudsman, the IFSO, the couple could not pursue their case. FSCL's CEO, Susan Taylor, stated that this case reflects a growing advisor liability gap, where clients lose access to dispute resolution after advisors sell their business or leave the industry. Taylor said FSCL has encountered 3 or 4 similar cases this year, and she expects such instances to rise as more advisors retire or transfer client books. The couple raised the issue with FSCL, but Taylor explained that because McQueen was no longer an FSCL member, they could not assist. IFSO also couldn't intervene, as McQueen's advice was given before she joined Advice First. Ennis indicated that the gap also resulted partly from the client's delay in filing the complaint. FSCL raised the issue with the Financial Markets Authority, the FMA, which then informed the Ministry of Business, Innovation and Employment, MB, to explore regulatory changes. Ennis clarified that She Consulting, an Enable Me franchisee that previously employed McQueen, terminated its FSCL membership in April 2023 after Enable Me's assets were sold to Advice First. Advice First notified clients of the change, assuring them that there would be no changes in how services were delivered, although, as the couple later discovered, recourse options had indeed shifted. The couple attempted to file a complaint after FSCL's membership period expired, leaving them unable to resolve their case through either FSCL or IFSO. In an effort to address their concerns, FSCL offered to investigate if the clients agreed to waive their right to legal recourse and abide by FSCL's decision, but Taylor deemed this option inappropriate, citing that clients should not need to forfeit legal options for access to fair dispute resolution. FSCL and IFSO have urged MB to consider a law change to close this liability gap, arguing that without access to free dispute resolution, clients are forced into costly and time-consuming legal action, which is really unfair. MB acknowledged the issue and recommended that the schemes coordinate solutions, although FSCL and IFSO favour legislative reform to ensure fair access for all consumers. As a final recourse, the client pursued action with the Disputes Tribunal, only to learn that it could not take up the case after She Consulting, the former Enable Me franchise entity, was dissolved. Now faced with limited options and high legal costs, the client is weighing whether to pursue court action to resolve their claim. I think this situation's horribly unfair, and it seems to be ridiculous that someone should be able to structure their way out of liability for providing advice, or at least being able to have a client claim against them for what they deemed to be unfair advice. So, yeah, I wish these people all the best of luck, and hopefully they get a resolution one way or the other. Stay informed and ahead of the curve by registering for our free events. Join us for our How to Succeed with Property Investing event. One of the things that we do is always recommend our clients crunch the numbers on mortgages at 7 or 7.5% interest rates, because 4.5% interest rates is well below the long-term average. In my opinion, that was really bad advice to be giving someone, especially when they asked for numbers to be crunched at 8%. Bad call. Anyway, in our free online and in-person sessions, we teach you proven strategies so you can make smart, informed decisions. Whether you're an experienced investor or just starting your journey, this event is filled with expert insights to help you to navigate the complexities of property investing and achieve your financial goals. In our free events, we'll also tell you about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up for one of our events. And just remember, we don't have any conflict of interest because we don't sell property. If you've already been to one of our free events and you'd like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.